We all know that a good correction should not be wasted. March was a very, very good correction to invest into. Companies which we thought were expensive gave away 30% of their market capitalization. They became 30% cheaper than what it was in the month of February. When a stock loses 30% of its value, you need to evaluate whether that stock is attractive enough to buy after the fall. And this judgment should be done in every single stock in your portfolio, and you should also assess whether you want to scale up particular stocks or all stocks. Because you have limited capital after a sharp correction, the money should go precisely to where it will work best. This is not easy. In theory, it is very simple, but in practice, you need to be very precise. If you manage to be precise, then you put the money that you have to good use, you put the money that the investor infuses into the portfolio also to very good use, and you scale up your portfolio very effectively using the correction. As an individual investor, it's entirely in my control to do it. But as a professional manager, I need the buy-in of the investor, because when the market is down, I cannot sell anything to buy this. But when the investor gives incremental money, he is giving me the opportunity to do exactly this. Interestingly, this is what has been my very, very important driver to generating both personal and professional returns. This is how I always raised my returns in my portfolios. So when the investor buys into the idea of investing during the dip and contributes whatever he can, let's say a portfolio is 100 in value, the investor gives me first 2, then another 3, then another 2, then another 3. He would have contributed 10% in all over a period of a month. Now, what happened to this 10%? Specific stocks got scaled up by 0.5% at a time using the progressively falling market, and we were able to raise stocks from anywhere between 1 and 2% in allocation within the investor's portfolio. Now, what happens after the market settle, like you're seeing in the month of April, is these stocks go up 20-30%. Now assume that I have added 1% in 5 stocks and they move up 30%. My portfolio at the aggregate level goes up by 1.5%. The overall portfolio gets an extra 1.5% returns. Compare this with the bounce back in the market from 31st March, which is anywhere in the region of 8 and 10%, depending upon when this video is going to be aired. So that is where outperformance starts coming back into a portfolio. That is where outperformance is earned by the buy-in of the investor and the precise actions of the investment manager. As a PMS manager, we have the luxury of doing this in every investor's portfolio, provided the investor shows conviction adequately during a correction. Many people say, oh, I am not convinced, the market is down, my portfolio is down today, so I will invest after the portfolio goes up. I always wonder when I hear this response from an investor. An investor gives 50 lakhs to a PMS manager. He has trusted him with 50 lakhs. When the market falls, he needs to put in 5 lakhs. 10% more. I am saying a floor level incremental investment. Maybe you can do more, but at least 5 lakhs. This 5 lakhs can make so much of a difference to the 50 lakhs which has already been put. By being stubborn and refusing to incrementally contribute that 5 lakhs to his own portfolio, the investor loses an opportunity to objectively act and take advantage of the market. I think at that point an investor lets his subjectivity and near-term judgment affect the performance of the portfolio going forward and stops him from showing the objectivity that can do good to his long-term returns. This is something that I would definitely like to change, and we make a lot of effort to change it. But at least 10 to 20% of the investors fail to show up objectivity at a time when they should, and they basically show more subjectivity at the time than they should. Because as an investor, when the valuation is in my favor, I always bring out the objectivity card. And when the valuations are too good to be true and the returns are too much in my favor, I actually bring out the subjectivity card. So when you play this objectivity and subjectivity card as an investor, is very, very important, whether you are an individual investor or an investor who has trusted a portfolio manager or an investor who has trusted a fund manager in a mutual fund. It's the same thing. If you look at what happened in March, I found that almost majority of the investors who have been investing with us brought out the objectivity card. They knew that this opportunity should be taken advantage of. And look at how much money they put into their portfolio. It's not as if somebody can put 100% of what they already invested in their portfolio. Nobody has that kind of liquidity. I don't as an investor. So I don't expect my investors also to have. But that incremental sum, it could be 2% first, then another 3%, then another 3%, and finally another 2%. Every little contribution to the portfolio made during very sharp falls in the market tend to deliver long-term outperformance and superior compounding to every portfolio, provided the manager is extremely diligent in deploying that incremental investment into the portfolio. I can't think, oh, he has just given me 2% and just tell my dealers, oh, just buy something. No. You have to be very precise in where that extra 0.5% goes inside a portfolio. And that's something I have learned as an investor over the years, that you can't be complacent or casual, you must be very precise. So you need to think in your mind continuously as to where you will put every extra 0.5% that comes into a portfolio. And if you get 10%, you get a chance to make 20 0.5% decisions. Now, imagine the market gives you a long duration to keep on contributing extra sums, like you saw post-COVID. And investors keep on contributing extra sums even in the form of an SIP. Assume that somebody has started a PMS of 50 lakhs and he does 1 lakh per month SIP. That's 2%, right? Just imagine 0.5% out of this 2% going every month into specific stocks, which make a huge difference in the long run. Think through it. A person who puts 50 lakhs in a portfolio puts 1 lakh every month for a period of 3 years. He adds 36 lakhs to 50 lakhs. Overall, his investment goes to 86 lakhs. Now, this extra 1 lakh keeps on strengthening the portfolio month after month for 3 years. Do you think such a portfolio can lose in the long run? Especially if the portfolio invests to a framework, to proper well-established investment principles with very good thematic construction, do you think such a portfolio can lose in the long run? My experience is it happens very, very rarely, and you should expect that you will succeed if you do this just the way I said it. Now, what if 3 years later we are in a market like we saw in March? The returns will look bad. But what will happen after that? Exactly what happened in April will happen after that. What would happen is the market would come back, it will regain its composure and it will regain its trajectory as well. But investors need to show conviction at that time also. Let's say 3 years later, for a brief period the market is not doing well, just extend your investment horizon by 6 months or 1 year. Be ready to give more time to your portfolio and continue doing the same thing. To my mind, the more time we do disciplined strengthening of a portfolio, the better would be the final outcome. So, it's not something to be concerned, it's not something to agonize over, it is not something to outrage over, it is something to accept, internalize and respond in a way which gives you what you want and what you originally invested for. This behavioral requirement is not just for an investor in a PMS, it is for every investor, it is for everyone who is doing investing on his own, it is for everyone who does his investing based on advice from wherever he is sourcing it. You need to show the right conviction and patience in the right place when the market is giving you opportunities and when the market is throwing assets at you. When the market is actually giving you an opportunity to buy the best of companies 20-30% cheaper, you have to see whether that valuation is something you like. And if you like, you must make those incremental investments. To my mind, these incremental investments are very, very important for the success of every investor's portfolio. You can't wear two hats saying that as an investor I will do this, but as a manager's portfolio I won't do it. You should do it for everything, because at the end of the day, every portfolio is your portfolio. A portfolio I manage is not my portfolio, it is your portfolio. So understand this, and this applies to every individual investor and every responsible manager. So show the same conviction whether the markets are up or down, because conviction shown when the markets are down, conviction demonstrated through actions when valuations are in your favor, are what generate outlier returns for you. I hope that more people understand this and stay tuned and keep investing month after month into the right parts of the market to generate superior long-term compounding. Thank you for watching this video.